Hey everyone, welcome to This Explainer. Today, we are absolutely geeking out on the life cycle of wealth. We're going to take the source material and basically track the journey of a single, crisp banknote, say a 5,000 rupees note. We'll watch it go straight from your pocket, run the gauntlet of taxes, and make its way all the way out into the massive machine that is our global economy.
Because, you actually live this cycle every single day, right? You get paid, the government takes its cut, and then you spend whatever's left over. But how do we actually map out that flow? Well, to truly get a grip on the macroeconomy, we've got to start with the micro. We need to track exactly where that cash comes from and how it moves around.
So, let's start with Section 1, the income in your pocket.
All right, the text defines personal income pretty broadly. Basically, it's the earnings received by a person from all sources. Think of it like a giant funnel for your finances. It's your absolute starting line. Whether it's the standard salary from your 9 to 5, rent you collect from leasing a spare room, or even dividends hitting your account from an investment, if it lands in your bank account, it counts as personal income. At least before real life gets in the way.
But, as we all know too well, the starting line definitely isn't a finish line. That brings us to personal disposable income. This is what actually survives after the payment of direct taxes. Stuff like your income tax or wealth tax. It's that very real tax bite. Your gross personal income might be this big, impressive number you negotiated, but your disposable income? That's your actual financial firepower. It's literally what you have the power to go out and spend.
Moving right along to Section 2, 8 ways to earn.
So the text actually breaks down 8 specific flavors of income, and we can group these up into 4 dynamic pairs to really see how they interact. Pair number 1 contrasts stability with risk. On one side, we have fixed income. This is completely stable over time, like your standard wages or the rent you predictably collect on the first of the month. On the flip side is fluctuating income. This one changes continuously. The classic example here is business profit. Depending on the market, it can be immensely positive, painfully negative, or just flat out zero.
Our second pair hits on a crucial, everyday reality for all of us: money income versus real income. Money income is just what you receive in actual cash, like that crisp 5,000 rupee note we talked about earlier. But real income? That's the actual purchasing power of that money. It's the tangible difference between the raw number printed on the paper and the actual basket of groceries that 5,000 rupees can buy you today versus what it could buy a year ago.
Okay, Pair 3 explores obligation. Contractual income is guaranteed by strict legal terms. Again, think of your negotiated wages or a commercial lease. But residual income is kind of the wild card. It's whatever is left over after making payments to all the other factors of production. Basically, it's the profit a business owner finally gets to take home, but only after the workers are paid, the rent is cleared, and the lights are kept on.
And our final pair is earned versus unearned income. Earned income means you had to actively participate in a productive activity to get it. You traded your labor, your capital, or your time for a paycheck. Unearned income, on the other hand, is the absolute dream scenario. It's received without any productive effort whatsoever. We're talking windfall gains or massive lottery prizes, though, I definitely wouldn't recommend building your entire retirement strategy around that one.
Now let's jump into Section 3, the 4 economic activities.
Let's see how all this categorized income actually fuels the wider world through 4 continuous steps. Step 1 is production. This is the creation of utility, making the physical things or offering the services people actually need. Step 2 is distribution, which is where the rewards of that production are divided up among society. This is exactly where those wages, rent, and profits we just covered are paid out. Step 3 is exchange, the actual monetary give and take in the marketplace. And finally, Step 4 is consumption, where we actually make use of those goods and services to satisfy human wants.
This entire macro cycle is just a continuous, unstoppable loop. The factory creates the utility, the distribution network moves it out and pays the stakeholders, and then the monetary exchange happens right at the cash register before the goods are finally handed over for consumption. And the second those wants are met, the cycle immediately demands more production, which keeps the whole economic engine turning endlessly.
So, as we wrap up this explainer, I really want you to look at your own life through this lens. Which types of income and economic activities are driving your daily reality right now? Next time you buy a coffee, realize you are actively fueling exchange and consumption. When you get your paycheck, ask yourself, is this fixed, contractual, or fluctuating? Take a second to analyze your own financial world, and you'll see these basic economic building blocks hiding in plain sight literally everywhere. Thanks so much for joining me, and keep questioning the economics around you.